Hello everybody, let's do a review of Suntec REIT's third quarter 22 numbers. So the price action for this REIT has been quite interesting, especially for the past 1 week. There was quite a decent sell-off on one particular day. I think the main focus and the key question is how long. How long is this Fed rate hike gonna persist on? Because this has quite a very dramatic impact on the financials for this REIT. So let's take a deep dive. This is the price action for the past few months. You can see the price action over here is very interesting, right? It's last week, right? One particular day when it opened at 153, and next thing you know, it got smacked down all the way to 128. Quite a big move, right? And the volume is quite high as well, 300 million. So this was just after the updates given by the management for this REIT. You can see the reaction was not positive at all, right? Very negative. You can see this big red bar sell-off over here. I won't be surprised if there are some short sellers involved as well. I think the main thing is, of course, the impact of rate hikes on this REIT, which is quite geared. Also, I think there's probably some fears about an equity raising exercise. I'm not sure if it's going to happen. But let's take a look at the financials. It's not very positive. Look at the distribution income from operations down 15%. So the DPU for this quarter is 2.08 cents, but out of which 0.2 cents is from capital, right? So you can see the DPU from operations is down 15% year on year. If you look at the capital management, they have quite a lot of debt in floating rates. So when rates rise and it's rising so fast, there's gonna be an impact. So if you look at the numbers, NPI is actually higher, so the top line is higher. But the problem, of course, is that the financing cost has really kicked in, right? Look at how fast the Fed has raised rates. It's not surprising at all, given the high proportion of the debt on floating rates. And also this quarter, they paid their management fees in cash and not in units, which is quite sensible because if you look at the share price of the units, it's quite depressed, right? Trading a very substantial discount to NAV. So it's not that ideal to be issuing units at such low prices because it's extremely dilutive. So look at the numbers, it's quite concerning. First of all, NAV is 2.13, so it's actually higher than the previous. Sorry, it's 2.097, down from 2.13. But then the discount to NAV is still quite substantial, right? So the share price is now 1.3. So you're talking about very big discount to NAV. So the properties are still very holding up in terms of their valuations because these are very good properties in prime locations. But the other than this fact, the other metrics are actually ticking down. Look at the leverage ratio is at 43%, so this is quite high, right? Among one of the highest in the S-REIT space. Debt maturity is also quite low, just 2.7 years, right? You're talking about the Fed potential hike path of probably keeping rates high for the next 1 year plus, right? So that maturity of 2.7 years is not that long compared to what the Fed is planning to do. So it's quite concerning as well if your ICR is just 2.5 times. So this is just barely at the MES suggested recommended levels, right? Also, a large proportion is at the floating rates. You can see the impact of interest rates, right? If rates go up by 50 basis points, the distribution income will be down by 5%, right? So if you look at the rates, they're kind of up by 2%, right? So we're talking about 20% impact on the distributable income, which explains why the operating income distribution from the previous slide was now 15%, right? So it's all coming from the interest rates, mostly coming from the interest rates. Although the NPI is higher, but this guy really kicked in, right? So it's not that difficult to understand. It's all quite mathematical. Look at the debt maturity profile is also quite concerning. So FY22 they have refied everything, but the 23 pillar is quite high, right? 21% is going to mature in 23, and it looks like this chunk will have to be refied at a higher rate when they come due, because the Fed is not going to lower rates dramatically in 23. In fact, there are some doubts over whether or not they will cut rates in 23. Because previously people were saying that they will hike rates and then start cutting in the second half of 23. I think that notion is kind of delayed already. People are penciling the possibility of keeping rates higher for longer. And if that happens, then the 24 pillar will be affected as well, right? And this guy is at 18%. So like 39% will be maturing over the next 2 years. It's quite concerning, right? It's a very big proportion. If you look at the projections and Goldman, they're saying that the Fed rate is going to peak at 5% in March next year. So this is up from 4.6% previously, right? So I made a video about it. I'll put a link over here. So previously it was like 4.6% FFR terminal rate. Now it's 5%. So you can see the impact is going to be quite decent on this fella, given the high proportion of floating rates, and then you have pillars expiring over here. So rising finance costs is the main concern for this REIT. But in response to all these concerns, I think the management has also talked about their plans. And one key thing I think is to unlock value, especially from the potential divestments of mature assets. So if you look at the assets that they have, I think one big possibility is the Suntec offices, right? Look at the Business Times, and they reported a few months ago, in 2022, that the transactions at the 3006 PSF, right? So if you look at the balance sheet that they have, the carrying value of the Suntec offices is quite conservative. It's probably in the mid 2000 PSF range. So if they sell the Suntec offices, they can unlock some value, right? And in the short term, address some of the DPU declines. So maybe do a capital top up, or maybe repay some of the loans, so on and so forth. If you ask me, right, in the short term, it's much better if they do a divestment as opposed to an equity raising, because if they do a divestment, they'll be selling assets above book, right, to address their problems. Whereas if they do equity raising, then they're issuing equity below their NAV, right? So for these two options, the office divestment is clearly the better option. There are also some other mature assets, especially in Australia, that might be possible for divestment, but it's all just speculative, right? So it's hard to say. I think the key problem though is that the assets for Sunset REIT is all very very prime assets in a prime location. So it's a good quality assets in key locations in UK, Australia, of course Singapore, Marina Bay area and the Sunset area. So very very prime location assets. So the capital values will hold. But problem is that these guys come at very low yields, right? So look at the MPI margins, it's like 3 plus to 4 to 5%. So if your assets are yielding 3 to 5%, but the Fed is going to raise rates to 5%, then you see the carry will just get eroded over time, right? So that's a big problem with the REIT. You have a very very good assets, but yielding quite low, right? So in the short term, I think the manager still has some levers to pull to try to address the concerns. But of course, the concern is how long rates will stay high, right? So if rates are going to stay high for the next 3 years, then it's going to be quite problematic because their average debt maturity is less than 3 years, right? So that would be a big problem. So I think the main thing is just hoping that the inflation comes down, and therefore the Fed to be less aggressive on the rate hike path. So that's all that we have for this video. So all eyes on the Fed moves for the next few months.